Yanni. Hi, Yanni. Where are you out of? Okay. Okay, well, this is going to be a super fun call. All the stuff that you didn't want to know, but you're going to need to know, we're going to do it today.
Yeah, she's going to be a new LO with us here in Clarksville with Lori and I, Yanni.
Okay, terrific. Well, welcome. Okay, so I have to figure out how to share my screen. So hold on one second. Oh, here we are. Can you see this screen? This Excel spreadsheet? Yeah, okay. And then, okay. So I can't see all of you now. My grid is small, so you just have to speak up when you want to. Okay, so we're gonna go over the financing section. And I noticed last time I asked a few what I thought were kind of basic questions and nobody knew the answers. So let's just take it from the top. Okay, so we quote mortgage rates in eighths. They're actually traded, all the way down to hundredths. That's why the points look funny. You get, it may say something like 100.361, and if you're like me, you're wondering, what is that, a 32nd, a 64th? Anyway, so they're traded just on the basis points, kind of the way stocks in the old days used to be traded on the eighths. If you listen to some old, radio show, they'll say, AT&T closed at 12 7/8. Okay, but they don't do that anymore. Now they just use the decimal system, so it would close at 12.87. It would actually close all the way down to the penny. So, but it's important, since we quote rates on the eighths, it's important to know this and to memorize this. You need to know right here where I'm highlighting the eighth decimal equivalent. So you need to know that 3/8 is 0.375, because you're going to be interchanging those numbers from time to time. And I don't know how to explain to you a decimal equivalent, except that you need to memorize this. If you actually took the number 5 and divided it by 8, you would get 0.625. So there it is, 5/8. So does anybody not know, if I were to say what is 7/8, would you not be able to say it's 0.875? Okay, well, I don't know what to tell you, except that you just need to memorize this little chart that I've highlighted right here. Now, we're going to look at these equivalents. So 1/8 is 0.125. It's also 12.5 basis points. So we had this discussion before. So what is a basis point? A basis point is basically 1% of 1%. Okay, so if you were to look at a $100,000 loan, 1% would be $1,000. 1 basis point would be 1% of that, which is $10. So 1 basis point on a $100,000 loan is $10. Does that make sense? So you just carry the decimal out 2 more places, and it's just easier, instead of us saying, well, it's 0.00125 of your loan, we just say it's 12.5 basis points. Okay, now it gets confusing when with pricing, when you have both above par and below par. Do you understand what the term par means? So Lauren, what does par mean? Is that a good day on the golf course?
I think par means like where it's priced out the closest to 100.
Correct. Well, it would actually mean exactly 100. So no points being paid, no points being paid back. It's exactly even it's par. There's possible, a lot of days, there's not a rate that's exactly par. You know, it costs a little bit or gives a little bit of a premium. But yeah, so if you say to me, well, today the par rate on your deal is 4.5%, I know it's not going to cost me any points and I'm not going to get any points in rebate. Okay, so how do we express that? So we want to stop. So as of today, never use the terms up and down. Up and down is very confusing. So you say, well, the market's up today. Is that an improvement, Nitty, if I say the market's up today?
Yes. No, no, it's no. Market is up today, no. The rates are up then.
Okay, well, it's confusing. You don't know. Maybe I was talking about your rebate is now up. So it's very confusing. So what's not confusing is better or worse. If I say, Nitty, the market's worse today, you know what's happening. You're either getting less rebate or the rate's going up. You know what worse means, okay? So let's use the terms better and worse. Okay, so when we express it, if we say, well, it cost one, you know, it cost 1/8 of a point, or it pays back 1/8 of a point, then it's also confusing if I say, well, it's 4 at 0.125, and you're thinking, is that a charge or a rebate? I don't know. Which way are you going? So we use we express that number in terms of par being 100.000. So par would be 100.000. And if it costs money, we subtract. So if it cost 1/8 of a point, you would see a price of 99.875. If it was a rebate, then you'd see 100.125. And that way, there's no misunderstanding. So if I say the market's gotten better, it's now 100.125, you know exactly everything that's going on. There's no confusion. I know this is dry, but this is stuff that you just gotta know like the back of your hand. Does anybody have any questions about that? Jump in. Yanni, what's on your mind? You're muted. All right.
I didn't understand it, but I
Okay.
don't want to hold everybody up.
No. What part? What part? I'll say it again.
You said the par is equal 100.00,
Correct.
and then you talk about the rebate. Like, so what is better between 101.0, which is right on the bottom, or 100.125? If that makes sense?
So 100.125 would pay a rebate back of 0.125. So your baseline is just 100.000. That is par. That is the baseline, however you want to look at it. That's the water level. If it's 99.875, then you're underwater a smidge or underwater an 1/8. That's how we express it so that there's no misunderstanding between a cost and a rebate. Does that make sense?
Yes, sir.
Okay. So let's talk about, we're getting all these little texts and things, you know, like I just told Nitty, we're all 40 basis points this morning, and we're worse 40 basis points. You know, what does that even mean? Is that like, oh my God, the sky is falling? Or is that like, you know, that's nothing, that, you know, it's no big deal. So let's look at what it takes to move the needle. So these are the value of a basis point. So 1 basis point on $100,000 is $10. So obviously 1 basis point is not that much money. But let's look on a larger scale. So 1%, this is an approximate, and the reason, so the numbers I just gave you on the chart above are exact, precise, accurate all the time. These numbers I'm going to give you have to do with the way bonds are trading. So this is more of a rule of thumb. Okay, on a 30-year fixed, 1% is 4 points. So if the market were to improve 4 points, then we would probably drop 1% in rate. They're 4.5 at par today, and somehow over the next week, the market rallied and improved 400 basis points, then we would probably see 1% in rate. So the basis points and the movements that you see quoted, those affect the price, meaning the points attached to the rate. So 1% equals 4 points. That equals 400 basis points. So our little market, we said we're off 40. If we look down at the bottom, so 1/8% in rate is equal to approximately 50. I'm sorry, 1/2 point, which is 50 basis points. As you can see with basis points and points, we're simply moving the decimal 2 spots. Okay, so right there, we lost 40 basis points. So yeah, we may lose 1/8 in rate, meaning it will worsen. So, so that's the equivalent of basis points to rate. Like I said before, there are what's called the bonds that are traded are at specific rates, and they call those rates coupons. Some are very popular and some are not popular. The ones that are popular and traded often, which are pretty close to the par rates, those are, they pay back more of a premium. They're priced more honestly. And then as you try and get away from that, if you were to say, hey, I've got a customer, I need the maximum rebate, what does 6% in rate pay as a premium? You're gonna be disappointed, because as you get farther and farther away from 4.5, it's gonna get tighter on you. On a 15-year, and then this is also true on a arm rate, the whole thing is compressed. So if you think about it, everything is pushed down so that you don't get as many basis points to 1%. So it's 300 basis points to 1% instead of 400 on a 15-year and an arm. It's compressed. So if you were trying to get a 1 point premium on an arm, you'd have to go much higher in rate. On the other side, if you could get the borrower to pay 1 point, then you would get a big improvement in rate, bigger than on a 30-year fixed. That's just the way it works. So here's your 30-year, and here's approximate for 15, but also for arms, which we're gonna see coming to market pretty soon. Any questions about this? Okay. Speak up. These are kind of, it's going to get more, this is the simple stuff, and it's going to get more complicated. So you kind of have to know that.
I have a question.
Sure.
So let's say, I'll take it as an example. So let's say if a buyer calls me and I offer him 3% rate, and he says, I want to buy points maybe to make it to 2.5%.
So knowing what you know right now, and it's a 30-year fixed, what would it cost him?
And let's say it's a $300,000 loan. So would it cost him? Yeah.
So look at
would
it.
it
So Nitty, look at the little chart. So what you're telling me is he wants to buy the rate down 0.5%.
Yes.
So let's look at the little chart, and where do you see 0.5%? How many points does it cost?
200 points, like base point 200 or 2 points.
2 points, right. So there you go. So on a $300,000 loan, he could pay $6,000 and he could get 0.5% better in rate.
Okay, thank you.
This is rule of thumb when you're driving in your car and talking on the phone and you got to tell somebody something. This is not exact. Depending on how those bonds are trading, it could cost 1.875. It could cost 2.125. But I'm telling you from history, this is approximately what it's going to cost.
Sure.
Okay. Now it's going to get complicated. Has anybody ever seen a chart like this? Either you get the text or you've looked up MBS highway and you've seen something that looks like this.
Mhm.
Let me see. I wish I could see everybody's smiling face. Let me see. Okay. Okay, so let's talk about what this means. Up at the top here, UMBS, United States Mortgage-Backed Securities, and then it tells you what the actual, what they call it a coupon, but what that bond is that we're looking at. So we're looking at the 3.5% bond, okay? And it opened today at a price of 100.39. That is not significant. I'm gonna tell you what is. Also, if you look down, you can see that the day change was, I'm pretending as if we're looking at these and it's 6 o'clock at night, the market's already closed. Okay, so we're not in the middle of the day. This is, we're just looking back over what happened today or yesterday. Okay, so the day change was plus 44 basis points. So Lauren, is that a good day or a bad day?
That is a good day
That is a good day.
because interest
What do you-
rates went down.
Correct. So rates and price work inversely, right? The more points you pay, the lower the rate. The bigger the point number is, the lower the rate number is. Okay, so, okay, but here's the thing. The up 44 is great, we're high-fiving, but that's not the most important thing, because what you're looking at is, I'm looking at my rates that from earlier today, and I'm wondering what's gonna happen tomorrow and how the market is affecting my rates. So at Van Dyke, we price off 10:30 a.m. So the market opens and we look at it and it's 10:30 a.m. when, if you can imagine, Brad Chattel, he looks at his watch, he goes, oh, it's 10:30. He goes and he looks at his screen and he writes down all of the pricing right then at 10:30. Okay, that is our anchor here at Van Dyke. Okay, it's not like the stock market. When you buy a stock on the stock market, if you've ever done that, you see the price, and if you buy it at the market price, you don't get it exact. It changes a few pennies every second. It could go up and down a penny or 2 pennies or whatever, and then if you just buy it, then you get it somewhere close, but it may, your screen may have said $28.35 and you ended up paying $28.36, you know, because the market's active and moving. But that is not how we do it. We do not, your rates and your pricing does not change every second. We have an anchor point, and our anchor point is at 10:30 a.m. and that's very, very significant. Okay, so what they tell you, because Barry Habib is super smart and he wants to make it easy for us, is, okay, I'm going to tell you what happened since 10:30 a.m. and we were up 28 basis points, which is also good, but not as good as 44. So what happened to the difference? So what is that? 14 basis points? I mean, 16 basis points? What happened to that? Well, it got absorbed in the pricing that they did at 10:30. Okay, does that make sense?
No.
Okay, so the market is up 44 for the whole day. We're looking back, it's 6 o'clock at night. Now we're looking back to see what happened today. The market's up, improved 44 basis points. But some of the improvement was early in the morning, and at 10, from 10:30 a.m., it improved 28 basis points. So if you subtract one from the other, that little bit of improvement, which is 16 basis points difference, that must have happened before 10:30. Does that make sense? So we improved at 10:30, we improved 16 basis points. Brad went, took his reading, priced the loans properly to market, and then afterwards, we improved another 28 basis points. Does that make sense?
Yes.
So we are starting the game off. It's like starting the game off up 3 runs, okay, for the next day. Okay, so we're all happy because we're like, we're gonna see some big improvement tomorrow. It wouldn't be big, but it would be a little bit, right, for 28 basis points. Okay, but then Tuesday rolls around and we open up. Let's see what happens. We're off 30 basis points for the day. So that's bad. Now we're going the other direction. Okay, from 10:30, we improved 17 basis points. Okay, so that means the market must have really opened bad, right? Must have opened off, 47 basis points because from 10:30 it improved, and all that improvement got us was down back to minus 30. So we got hammered in the morning. So your improvement that you thought you were going to get is gone, and also even a little bit worse. I'm gonna go through this on a line chart, but I just wanted to show you what this means. So do you see how that works? So on a day where the market opens higher and closes higher, you could have worse rates because you don't know what happened before 10:30 a.m. And then at 10:30 a.m. they get a reading. Well, the market could have been well, so the market could have gone up and down and up and down and up and down. So just knowing the open and close doesn't really tell you the whole story. The important part is that anchor time, which is, Laura, when's our anchor time?
10:30.
10:30, right. That's the key.
I have a question.
Yes.
When you're looking at these and you say, you have the day change and then we've got the additional changes at 10, 10:30, and 11. That's not in addition to, correct? That's just so if it opened at 44 and now at 10:30 it's 28, that's not 28 in addition to that 44. That's where it actually went down from 44 to 28, correct?
You're absolutely correct.
Okay.
And that is an important point. And if you're looking, you're like, well, it told us how the day ended, and it doesn't even give you the open. The open is really insignificant because all you care about is what has happened since pricing came out at 10:30.
Okay.
And if it's early in the morning, all you care about is what's happened since yesterday's pricing at 10:30. So instead of the normal open and close like the stock market, you're interested in what happens between these 10:30 anchors.
Okay. Thank you.
So yes, so your point is absolutely on par. Okay, this is going to get a little confusing, but I think it's important to go through it. If we were to start, let's say that we start the week and by some miracle of coincidence, we ended last week at 0, everything was 0. Okay, it ended exactly where they priced, so everything's 0 to start with. Okay, so Monday comes along and our anchor, we're up 28 basis points. Okay, so the change when pricing comes out is up 28 basis points. So typically the pricing will be a 1/4 point better. They're going to round and they're going to round down. Okay, so they're going to take that 28, make it 25, and make your pricing a 1/4 better. Okay, we ended that day up 44, so we kept improving. So we improved 19 basis points from what they gave us. So you're probably looking at that and you're saying, well, no, Stephen, the math doesn't work because it should be 16 basis points. But in theory, they kind of shorted us 3 little basis points because we're up 28 and they gave us 25, right? They rounded it, okay? So we end the day, and the theory is, if you can think of it this way, they owe us 19 basis points. The company owes, right? Because that's where our pricing was at that anchor time. We got 25, but now at the end of the day, it improved a little more. So they owe us 19. Does anybody make sense? Does that make sense to people when I say they owe us 19? Speak up.
So on days when we would end lower, like the next day on Tuesday, when you're down 55 points, does that in theory mean that we then owe them 55?
Okay, we're getting to Tuesday right now. Just wanted to
Okay.
get to that. Okay, so now they're gonna take another reading, and the reading for Tuesday is up 17. You're like, damn, they already owed me 19. Now I'm picking up another 17. They owe me 36.
Right.
But Brad's very conservative. So he only gives you a 25 basis point improvement. Okay. You're like, all right, whatever. I just got gypped out of 11 basis points, but he'll catch up with me. It'll catch up with me. Okay. But then the Fed talks during the day and the market tanks, and it ends the day minus 30. Okay. Well, I already got 25 better that day. So I owe them 55 basis points. So at the end of that day, if I have anybody thinking about locking in, I need to get that lock in, because I know tomorrow is going to be a friggin' storm, right? I mean, as far as rates go, because I'm now in the whole 55 basis points. Does that make sense? He gave us some, but then the whole market turned around and went from all these happy times of plus, 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 and just got slaughtered. And now it's minus 30. Who knows? Unemployment rates came out, or the Fed was talking about something, and this can happen. You have this whiplash effect. So now we owe them 55 basis points. Does anybody understand this? Does anybody not understand it? Okay. So now the day of reckoning, Wednesday's coming, and you're praying, hey, listen, maybe we'll have a little bit of a rally in the morning, right? And then, we'll just sweep this under the rug and not mention it to anybody. Okay. But no, the opposite happens. It opens up and it's worse again, right? So this is what's been happening lately. We think, that these bond traders, okay, well, they had a really bad day yesterday. Maybe tomorrow it'll be better. No. So it's worse again. So then you have to say, well, we owed them 55. Their anchor pricing is minus 16. Hell, now we're 71 basis points worse than the last anchor price. So then they just slaughter. They just go 3/4 of a point worse. Okay. A rate sheet goes 3/4 of a point worse. Okay. We end the day up 5 basis points. Okay. But because they already took the, made it 75 basis points worse, the balance is, now they owe us 9 basis points. So you can see right here, it was 71 worse, but Brad overstepped and took 75 from us. So he took an extra 4. We ended up 5. So that makes 9. So then now marketing owes us 9 basis points, which is not even 1/8 of a point. And we're crying about the fact we should have locked in Tuesday. Does that make sense?
So I have a question.
Yes.
If you price someone on Monday and they didn't want to lock, and then on Wednesday, does that mean that really from what you priced them on Monday to Wednesday, they're only a quarter worse?
Yes. Yes.
Okay.
Right. Because you improve. So, okay, so let's say you priced them first thing in the morning, Monday, before the rate sheet came out. Then we got the improvement Monday at 10:30. Then we got another improvement Tuesday. And then you price them after the rate sheet comes out on Wednesday, it goes 75 worse. So, right. So you're actually a quarter worse. Yeah. So I've had that where, you talk to a borrower and then 10 days later, they put the house under contract and you wonder, oh my God, rates have, just been so volatile, up and down, crazy. And it's basically the same price. Even though, back in the kitchen, we were going up and down and up and down. So, okay, any questions about that? Because I'm about to throw you a curveball. Okay, so we have this 75 worse, on Wednesday, and you're probably thinking to yourself, Stephen, I've been here a long time. I've never seen them hit us with 75, 3/4 of a point in at one shot. Well, you're right, because what would happen is as this sell-off happens on Tuesday afternoon, see how we started off good and then it ended up minus 30 on Tuesday? That was the day we had the whiplash because the Fed spoke about some BS that scared everybody. Okay, so what Brad's going to do most likely is jump in right then and give you a price freeze. Okay, he's not going to wait till the next day. He's not going to let you get all your locks in, you know, Tuesday night when you owe them 55 basis points. He's not going to let you do that. So what he's going to do is he's going to have a midday price hike. So if you look on the little chart below, then basically Tuesday afternoon, midday, he's going to go ahead and hit you with a quarter right then. Might be 3 in the afternoon. You've seen this a million times. Okay. And what that does is that simply gives you a new anchor. And what that does in the long run is really nothing to our so-called balance. It's just the fact that he went ahead and he grabbed a quarter Tuesday afternoon. So now when all this mess happens Wednesday morning with it opening worse and being worse, he's going to hit us for a half a point because he basically got 25 basis points yesterday afternoon. Does that make sense? They're not going to wait and give you this 3/4 worse pricing. He's going to go ahead when the market turns and do a reprice. When he does a reprice, then we get a new anchor point. And instead of it always being at 10:30 a.m., the new anchor point is going to be whatever time those new rates come out, which could be 2:37 in the afternoon. Who knows?
But then that anchor point is only for that day because the next day we reprice again at 10:30.
Correct.
Okay.
Correct. So no matter how many times he reprices, he could reprice twice in a day. We've seen that. That last repricing is the new anchor point. Because basically what happens is he's settling the tab. So he's settling the tab when he does that. He's trying, you know, he's getting the pricing to reflect the market when he takes his readings and the price comes out. Does that make any sense to anybody? Adam, is that making sense?
Yes, sir.
All right, jump in with questions if you have any. Okay.
Yeah.
So here's some house rules so that you're not totally blindsided. Marketing will typically reprice worse if we lose 25 basis points or more. They typically will price better if we improve by 38, basically 3/8, which is 37.5. So I know they're taking a conservative approach. They're being stingy when the market improves, but that's the way it works. They're trying to protect Tom Van Dyke so that they don't get hit with some huge sell-off and stuck with a bunch of blocks. We already talked about don't use terms higher and lower, use better or worse. Everybody knows what you're talking about. And here's the thing. To sound intelligent, when you ask me or your manager or Brad Chattel, our secretary, for a price concession, don't tell them, hey, can I have $172 on my loan? That's meaningless. They don't know if you're doing a $50,000 loan or $1 million loan or a jumbo or a conventional. They don't know. They know what their margins are, but they don't know about your particular loan. So the way you express it is in basis points. So if you look at your pricing and you have promised the customer that you were going to quote him 4.5 with 0 points, and now it says that it's 99.80, then how many basis points are you short, Laura? Okay, Laura's on mute.
I was trying to find the button to unmute it. I have that problem all the time.
So you tell the borrower you're at par, you look and you're like, holy crap, today we're at 99.8. So how many basis points are you short?
Well, I'm crazy here, 20.
20, right, you're short 20 basis points. So you would email secondary and you would say, on the Jones loan, number 1234, can I please have 20
An
basis
exception.
points?
Yeah,
And then you sound like an intelligent person and they're likely to help you out. And you know, if you're asking somebody for money, you might as well make it as easy for them as possible.
mhm.
All right, this is the toughest part, the most confusing part. Does anybody have any questions about how all these numbers work? Okay, so here's the thing, here's the paradox. So even if you are an expert on this part of studying the market, and even if you're able to somewhat predict, because you're a genius, what's going to happen, I'm going to tell you, don't use this knowledge. Okay, have the knowledge, but you're going to be tempted. You're going to look at charts and graphs and you're going to say, I have a feeling that we're going to see some improvement tomorrow. I'm going to hold off on my lock. Don't do it, because the market takes no friends. Okay, you know, like she like I said, you know, she'll love you like your best friend one day, and then the next day she'll leave you like one of those Kardashians. You know, they just don't care. The market has no conscience, and I've seen it, and it gets worse 3 days in a row, and you go, oh my God, it's oversold tomorrow. It's got to be good. And then it gets worse again. So please don't play the market. And in today's world of originating, there's no reason to. Your commission's set. So all it's going to do if you make a mistake is have you have a painful discussion with your manager about how you overslept, didn't get your lock in, and now you need $1,252 for whatever it is. And that's
Mhm.
not fun. Okay,
Been there, it stinks.
I've been there. As smart as I get, I do make some dumb mistakes. Okay, let's talk about, let's skip this and go right to candlesticks. Has anybody ever seen a chart like this?
No,
Has anybody seen a chart like this?
Yes.
Yanni, Laura, okay. So Nitty, let me ask you something. Rates have been getting worse, right?
Yes.
Okay, this chart looks like it's going down. Why is it going down if rates are getting worse?
is it the pricing?
Laura is correct. This is not a chart of rates. This is a chart of prices. So the rate is the rate. The price is really the points. Some people use the term price to mean rate and points combined. But either way, so what it is, this is a chart of a mortgage-backed security at 4%. Now, there are a million influences to mortgage rates. Adam, give us a couple of things that influence mortgage rates.
I guess, well, interest rate, how the market's doing for the day.
Okay, so a couple of things. So there's a lot of influences. So the stock market influences it because money flows from one market to the other. The price of oil influences it. The 10-year bond price, it influences it. The CDs rates you get at the bank influence it. So a lot of different influences, but mortgage-backed securities is the one that is super closely tied to interest rates on mortgages. So that's why we use that. And you'll hear on the news, well, the 10-year long bond went up and on, and that's a definite influence. The Fed is an influence, but this is the only thing that's a direct correlation. So that's why we look. Okay, so mortgage-backed securities, and this particular coupon we're looking at is 4%. Okay, and I don't have the dates on here, but let's say that this is January. Oh my God, look. I just want to show you, here's our friend Barry Habib telling us the market is once again getting worse.
I just got a reprice alert a few minutes ago.
Yes, if you have to lock it alone and you want to just put me on mute and lock in, I totally understand. Okay, so we see that back then in January, the 4% coupon paid back, this says 6.5, so 6.5 point rebate. Okay. Back in January. And then each one of these, can you see the little dashed lines? So
Yes.
each one of these means we lost 50 basis points. So we're kind of cruising for a couple of weeks here. And then all of a sudden you see it gap down. And by the time we hit February, we're down to 4.5, which means that we lost 2 points, which on our little chart, 2 points equals about 0.5% in rate. So I've never seen a decline this fast. And then it just keeps going and going and going to the point that we're losing. We're off like, I think, almost 600 basis points. Let's see. Yeah, so it gets down here. So we're off about 500 basis points. It's really crazy. Okay, so what are all these things? You see the general trend. Let's look at the lines. So these lines right here, the green one is the 10-day moving average, meaning if you go back 10 days and you average it and you just keep drawing little dots and making a line, it's going to be the most volatile, and it's the green one, and it's sloping down. The blue one on top of it is called the 50-day moving average. Obviously, the longer time period you're averaging these numbers, the more stable the line's going to be, but it's also moving down. And then the one on the top is the 200-day moving average. So it's, going very, very slowly down. They're all getting worse. But when you see the short terms be steeper, see how the 10-day is actually steeper and the 50-day is steeper than the 200, that means the losses are accelerating. So it's not, it's getting worse, and it's getting worse even faster. So that is a little bit scary when you see that pattern, but that's where we are right now. Okay. Aren't you glad I told you that? So now you can be sick to your stomach. Okay. So what are all these little things? They're called candlesticks. And the magical thing about candlesticks, the reason why it's not just a bar chart, you can have just a bar chart, right? And tell you where the points are. But this little candlestick gives you 5 pieces. This is the Japanese candlesticks because they invented them like 200 years ago. And this one little thing, this one little candlestick gives you 5 pieces of information. I bet Adam, do you know what? Give me some of the information you can get from this one candlestick.
Sorry, Stephen, I was away. What's
Oh,
the question here?
No, Adam, hey, so this one candlestick, can you give me, it gives you 5 data points. Can you tell me what any of these are?
Starting point, end point, midpoint, an overall finish.
Correct. So, okay. So Adam got most of them right. So here we go. So red, when you see that it's red, you automatically know the day has worsened. Okay. So very quickly your eye sees that there's many more red than green, right? So, and also you see that the bigger ones are red, which is not a good sign. Okay. So, okay. So the color is the first one. I'm calling that C. That tells you that the market got worse. Okay. Then we will look at the starting and end points of the thick block. So B and D. Okay. So B and D shows where the market opened and where it closed. Okay. We know that it opened at B and that it closed at D. We know that because it's red. If it were green, then it would be the opposite. It would have opened at D and closed at B because the market would have closed up in price, which is improvement. Okay, so the A and E, the skinny line, shows the highs and lows of the day. So we know that the top A was the highest trade and E was the worst trade. So that if you see a lot of the skinny line compared to the thicker line, then it shows a highly volatile day. And if you see that there's not much of the skinny lines poking out, then the day pretty much kept steady as far as the up or down trend. There weren't some wild trades that happened. It kind of opened or closed and then trended up or down and closed at that point. Does that make sense?
So does that mean that that one only kind of worsened a little because there's not a whole lot of difference between the skinny line at the top and the bottom?
So the worsening would be the thick, the final, when the bell is rung, the final worsening is the thick part. And I mean, in my eyes, I know that I blew this one up. This would be a significantly bad day.
Okay, so it's really not even a matter of, honestly, the skinny lines.
The skinny ones really, those are the highest trade and the lowest trade. They really indicate volatility.
Okay,
So, we want to see that there's less volatility. We obviously want it to be green. And I mean, in reality, we just want small green, thick lines for the whole thing, because we don't want any kind of huge jump causes us headaches in either direction.
so when you look in your graph above here, when you're on like J up there, so from J to K, that was actually a fairly decent time right there, because there was very little difference, a little bit of green, a little bit, but the red was small.
Right here?
Yeah, from there to the
so
next
here,
line over for K.
Yeah, so here up at the very beginning, this is what's typical, okay, is the first week over here. This is what's typical. And so it's not good when you have a day like the fourth one where the skinny line is really big. That means that although we only closed off a little bit, there were traders that were really, undecided. So they went way high and then way low. So it's volatility. It's kind of a heads up that something ahead of us
I see.
may not be good. Where, where there's only a little bit, like these 2 days where the skinny part is only sticking up a little bit, that means that, well, it's just kind of a calm day. It just got a little bit better and a little bit worse, and nobody was really freaked out by anything.
Gotcha. Okay.
Does that kind of make sense?
Yep.
But it shows you how brutal. You can see that this red line right here is more than, since the dash lines are 50 basis points, that looks like it's about 70 basis points. So almost 3/4 of a point loss right on that one day. And I mean, borrowers like floating, to try and get a better rate or whatever. I mean, the market can be brutal. You don't have to understand these candlesticks to the fullest degree, except you do need to understand that when they're big, that there's a lot of action, and that green is good and red is bad. Does that kind of make sense? Okay.
Hey, Stephen, would you touch on the floor and the ceiling as well?
So, yeah. So what Adam is talking about, whoops, I accidentally screwed that up. So there are these lines of resistance that, and this is oftentimes what you'll hear Barry Habib talk about, okay? And there's various reasons why they have these lines of resistance. They could be like, this was the all-time low for the last 12 months, okay? And there's also this crazy thing called Fibonacci numbers, which is like half science and half psychic or whatever, where they come up with these lines where these prices are. And then the feeling is that they will hit these lines of resistance and bounce back. And a lot of times they do. And the other theory is that if they break through it, then you're going to the next one. So in other words, once you lose a little bit, you're going to lose a lot. So you might as well just go ahead and get your locks in. I mean, this is from a bond trader standpoint. We're always locking when we take loans, but they're thinking about those things. So you can see a lot of times, once you break through a line of resistance, like this one right here, so you can see that, okay, on this day, it bounced right off the bottom, improved a little bit, bounced right off the bottom there, closed right, and then it broke through. Once it broke through that line, then you're almost guaranteed it's going to go to the next one. So you're going to lose, you know, so the idea is like, let's say you're 10 basis points away. Once you lose that, you're losing another 50 basis points for sure. Because what happens then is these lines of resistance that acted like floors actually act like ceilings. And you can see 1, 2, 3, 4 days, it becomes a ceiling for us. And the breaking through has to once again happen on the other side. So it gets a little bit complicated, but a lot of times you'll get a call from Barry Habib and you'll wonder, hey, you know, the market's not even off that much. What's he call? Because we just broke through a level of resistance and he's not comfortable with that. And so he's going to let you know that, you know, you're probably going to have rough days ahead of you as we fall to the next level of resistance. I know that now that's more than you wanted to know, but Adam is super smart, so I wanted to fill his brain with good knowledge. So what do you think? Any questions about these? And you want to, and now you hate all Japanese people for coming up with these crazy things, but don't do that. Okay, so all right, so we're done with candlesticks. LLPAs, we're going to move fast. Who is not familiar? Be honest with me. Who is not familiar with this chart right here?
I am not.
Come on, Adam. This is the Fannie Mae LLPA chart. I know you're.
I do. I have it on my computer. I just don't have it memorized.
Oh, right. Okay, but you know what it is. You know what it is, right? No, nobody has it memorized, but yeah. So you know what it is. Okay, so these are all the conventional adjustments for credit score and LTV. Okay, I keep this taped. I refer to it every day, sometimes multiple times per day, and I keep it taped to my notebook because I can never be without it. Okay, this tells me lots of things. It tells me that when a borrower wants to put less money down or do change their loan, you know, what it's going to cost them. And it also tells me whether they're a candidate for a rescore. So if they are doing a 75% loan, right here, this column right here, and they pull a 699 credit score, then I know it's a 1.25 hit. And I run the credit thing and it says, well, they can improve to a 715 if they pay off their Walmart credit card. Well, I'm not going to make them do that. It's a 1/4 point. That ain't going to change their life. That isn't that big a deal. So we skip it. But this guy over here is wanting to do an 80% loan and he's got a 675. And if he pays off a credit card, it goes to 685. Well, that's a whole point difference. So if it's a $300,000 loan, that's a $3,000 savings. In fact, his savings may be more than the credit card he's paying off. So do you see how that would be a big benefit and how that customer would be a candidate for rescore? So keep this handy. Okay, so is the pricing better on an 80% LTV or a 95% LTV? Yanni, it's better on an 80 or a 95? Assuming they have good credit, 740 credit.
Can you please say that question again?
Yes. So is the pricing better on an 80% LTV or is it better on a 95% LTV? For somebody.
There's no difference.
Okay, show me.
So you say 80%?
Yes.
Oh wait, 80% is worse than the 90. I'm sorry.
80% is worse. Yes, it's worse than 95. So the reason is that the investors like mortgage insurance. Who wouldn't want an insurance policy on their loan? So they give you an extra 1/4 for that. Is that a big deal? No, most of the time not, but it's significant because I've had borrowers say, listen, I'm trying to put 20% down so I can get a better interest rate. And then you say, actually, your pricing is a little bit worse, and they totally don't understand. So that's one thing to keep in mind. The chart below it is for cash out. So if a borrower does a cash out refi, so Nitty, let's say I'm going to do I have a 740 credit score and I want to do an 80% cash out. Okay, we get those all the time. So what is my pricing hit going to be?
0.875. You're asking the price.
I'm sorry, what did you say?
0.875, 38, 78.
Okay, so you have to add them together. So you have to take this half a point and the 0.875. So their hit's going to be 1.375. So you can see that if their credit score is low and they're trying to do 80% cash out, it gets super expensive. And, you know, those are higher risk loans. Does that make sense? Cash out, you got to add them both together.
Mhm.
Okay. This is tricky. Who's done a piggyback before, first and second together?
Yes.
Yes.
I've done DPA, that doesn't count though, right?
Now, where they do a HELOC. So there's a number of reasons to do a HELOC. You can do a piggyback HELOC to avoid mortgage insurance, or let's say you have a large loan amount and the jumbo rates are a lot higher. Also, the one reason that I get a lot of requests for them is that they are selling a house and they want to then put the money towards the new house and get a lower payment. Well, we can recast, but there's some issues with that we can talk about later. But the one thing they can do is they can do a first and second. So let's say that they're buying a home for 600,000. They have 100,000, which is plenty enough to buy the home. But when they sell their old home, they're going to get an extra $200,000 that they want to put towards the house. Well, we can do a first mortgage with a $200,000 HELOC, and then they just pay off that HELOC when they sell their house, and they're left with the one small mortgage that they wanted to begin with. Does that make sense? Okay, but now how do you price it? So, Nitty, what if you want to do an 80-10-10 and the person has a 700 credit score? How are you going to price it?
It would be 0.75 plus the above, like whatever it was, like in the first chart.
Okay,
It will be
so
plus point.
okay, so let's talk specifically what's the price hit for adding the second. So forget about the top charts. I'm just looking at this one chart.
It would be 0.7.
1.375.
Their credit score is less than 720.
So it's confusing. So here's how you do it. First of all, anytime there's a second, no matter what, you got to add 0.375. Okay, so that's how you start out, by adding 0.375. Then there's a second adjustment, and that's on that little chart. Your LTV is 80%. So it's going to be, if you look at the third box, it's going to be between 7501 and 95. There's two choices there. So we look at the next box, and it says that the CLTV is going to be 90. So you're going to take the first one, which is I don't know how to express, it's the second one from the bottom. It says 7501 to 90, because 80% is in there. Your CLTV is 90, so that's going to be this one right here. Your credit score is 700, so you're going to have to add a point. So your total adjustment on that is going to be 1.375 points more. Does that make sense?
Mhm.
Is that first box is a credit score over 720?
The first one is the under, and then the second box is the over.
Right, okay.
So it gets a little bit tricky but there's the basic thing I wanted you to know is there's two price hits when you do a HELOC. It's the 3/8 plus what's ever in this matrix down below.
Mhm. Is that standard for every lender, or will that change based upon whatever the lender wants, that 0.375 point?
So that's an excellent question. So these charts that all three that we've looked at on this sheet are from Fannie Mae. They're Fannie Mae loan level price adjustments. And as you can imagine, Fannie's little brother, Freddie, has been a copycat and done exactly the same thing.
And these all changed, this is what all changed at the beginning of the year, wasn't it? Where they were telling us that there was going to be some adjustments to this?
So the big changes were to the second home purchase. So this actually, these three charts I'm showing you did not change. I believe they came out in 2018 or 19. So they've been around about 3 years. So that big change was now there are much bigger pricing hits for second homes.
Oh, I found that out.
Basically, they're treating second homes like investment properties because our borrowers were committing occupancy fraud, buying a second home, and then renting it out. Well, it's a different risk level when you have a rental property than when you have a second home, and they weren't pricing that accordingly. So I hate to say it, but the borrowers in the industry shot themselves in the foot with that one.
Oh, yeah. Yeah.
Okay. One more thing about finance, and that's APR, because we had a little bit of a discussion about this. So it seems like the APR is always higher, right? Does anybody, Stephanie, do you know why APR is always higher? How come it's not lower? Okay, so the APR takes in consideration the closing cost on the loan. The government came up with this wonderful formula that doesn't work, but the idea behind it is they have tried to combine everything so that a shopper can shop. So they go to us and we quote a rate of 4% at par. They go to another lender and it's 3.5 with 2 points, and another lender it's 3% with 4 points. And we know that on our rate sheet, those are all the same. We'd make exactly the same money and same margin on all those different deals. But the government says it's too confusing. We want to boil it down to one number. Well, it's impossible. But to understand APR, it works like this. So if you have a $200,000 loan amount and the rate is 4.5%, and it's a 30-year loan, and your closing costs are 6%, the payment is actually $1,013. That's the truth. I ran this on a calculator. So that makes sense, right? Typical deal. Okay. Well, the government says, hey, listen, if you're charging $6,000 and I back that out, the borrower isn't ending up with 200,000. They're only getting 194 net at the table, right? And that makes sense, right? So they're getting net 194,000. And let's just forget about even talking about closing costs. We'll just zero that out. So if the borrower gets 194,000 at the closing table, and we already know their payment is 1,013, we can do a backwards calculation and say, okay, well, the yield on that is really 4.76%. So that's really what you're charging them in effective yield. Does that
I
make
have a question.
sense?
So we are taking two scenarios in which the closing cost is 6,000, in which one of the, which is like buyer is not paying when we say 200K loan amount.
This is
When
the
we
same
say the
scenario.
loan,
This is a normal scenario, borrowers paying 6,000 in closing costs. Okay, what I'm saying is the government looks at it in their mind as saying, hey, if you're charging money, they're not actually getting the 200,000. They're getting what 200,000 minus whatever you're charging them to do the loan. So they're only really getting 194,000 in theory. Okay. And if we take the payment you're charging them, then we can do a backwards calculation and say, well, really, the proper rate, the effective rate is 4.76. Does that make sense?
rate and the APR would be same in any of the scenarios, or would APR
That's an
always be
excellent,
higher?
that's an excellent question. Yanni, what kind of scenario would the APR and the rate be exactly the same?
Oh, when the borrower don't pay closing costs?
Okay, so I think what you're saying is when there's no closing cost, because they make us, even if somebody else pays it, they make us do that anyway. So let's just say we do at 4.5, we're able to get enough lender rebate that we pay the closing cost. So the borrower literally has no closing cost. In that case, the APR and the rate would be exactly the same because there's nothing to subtract. So then when you do your, whether you do the calculation upside down or backwards, you still get the same numbers because we haven't changed any numbers. Does that make sense? So typically, like on a credit card or a car loan, you'll see the APR and it will be the same as the note rate because they don't charge a fee to get those loans. If they do, then it will vary a little bit. Okay, so why don't APRs work? Why isn't this a great tool? I'll just shop APRs.
Because you don't know what will be involved in the APR, in the closing cost. No?
Okay, so it's a, but here's the thing. There's this thing called discount points. So we can screw with this. And if you start playing around, what you find is that the more discount points you charge, the lower the APR. So if this person were to able to get a 3.5% rate with 4 points, his APR would be lower. It would be something like 4.25, and it would be like, oh, well, that's the best deal. But you and I know that paying 4 points would be $8,000 plus 6 would make his closing cost $14,000. And I don't know anybody that would recommend a borrower pay $14,000 in closing costs on this loan just to drive down this magic formula called APR. If they were to leave the home before, you know, their break even, which is probably in the 20-year range, they would be gypped out of the money. So in my eyes, the best deal is to try and get the closing cost the lowest and let the rate go a little bit higher. But nevertheless, we have to disclose APR regardless of our opinions. It's the law.
I have one more question.
Yeah.
So you said if the borrower buys the point, he can bring his rate down, which I know, yes, he can. And then the APR would also go low. But won't the rate also be like on the LE or on the closing sheet? The rate would also be like 3.5, let's say, because he's buying the points. And the APR would be, let's say, 3.6.
I mean, I can't figure it in my head, but your APR, yeah. So the APR would end up, even though you're going to have to take this formula where you subtract off, you know, another 8,000. So you'd have to change this to where you make the effective loan amount 186,000, and then do your calculation. The way the numbers work is the more you buy the rate down, the better deal it looks, the lower the APR is. And that is just not the truth. If that were the case, people would say, what's the maximum I can spend to get a loan? And of course, I haven't had anybody ask me that.
I have a really stupid question.
Go ahead.
Other than the fact that we have to be within a certain percentage of what the APR is, correct? Other than that, do we really, this is stupid, do we really need to be concerned overall with what that APR is?
No, we're not. I'm not concerned at all. We shouldn't be
Okay.
concerned. The borrower shouldn't be concerned, but it's the law. So we have to always quote APR. If you ever advertise rates, which I suggest that you don't, you have to put the APR, and it has to be the same size type. You can't put, we'll do your loan at 3.75 and then real small, put 4.5 APR.
Right.
You can't do it. Yeah, they make you put the same size type. So anyway, I just wanted you to understand how it works so that when the customers ask you, hey, aren't you really charging me 4.76? No, your payment is figured on the note rate, and that is 4.5. The 4.76 is a government formula that they thought that you should have, but it doesn't really work. And on ARMs, not going to discuss it in detail, you get crazy APRs because it works off of like, what if it was the worst case and it went up the maximum and it did this and that, and then your APR is crazy, and it's totally meaningless instead of mostly meaningless. Okay. Any questions about this? I understand that it is dry. Did anybody learn anything?
Absolutely.
Okay.
Yeah, this has been really helpful.
Okay, good. So let me get back here. Hey, there you are. Okay, so let's get to the fun stuff. Okay, so I sent out this thing about Power Hour. Who looked at that? Who thought
I did.
about it? Okay. So Yanni, this is where you designate an hour a day to prospecting. So Laura, what I want to know are three things. What time did you pick? Who are you prospecting? And how are you doing it?
I usually do mine in the evening. I don't have a specific hour, but it's usually in the evenings around, I guess it is a specific time, around 5:30.
Okay.
And I reach out to my referral partners. And I
To your agents.
Yep. Send them quick text messages, letting them know that I'm available, or following up on a particular client that we may have pre-called already and seeing, if there's anything I can do for them, or do they have any other clients that they'd like me to take a look at? That's pretty much what I do.
Right.
And I'm available until 9 o'clock in the evenings. So I let everybody know that.
Okay, so that's good. So the thing to do, the strategy behind this is to be disciplined in your prospecting, to pick a certain time every day and stick to it. A lot of people pick between like 10 and 11, 11 and 12, and when you start out, I'm not opposed to you starting out with a power half hour. Okay, that's okay to get in the groove. But if you know that every day at 9:30 in the morning or 10 o'clock in the morning, you're going to be making your calls, then you tend to stick with it more. And when you do your scheduling and stuff, you have that always there. So the idea is to break your prospects up into at least 4 categories, 5 if you have them. So, and it's up to you to figure out what's best. But typically, it's Monday, I'm calling all my prospects to see, all my TBDs or prospects to see if they found a house and what's going on, to keep touch with them. And what John Jones alluded to in the Facebook page, which is very smart, is you might want to just update them on rates. So you don't come across a guy who says, hey, I just found a house. We talked in January and can I still get 3.5%? So, I mean, you know, they don't know. So yeah, it's a big joke to us, but they don't know. They don't watch CNBC looking for the employment report to come out. So they don't know. So if you tell them all along every Monday, okay, well now it's 3.75, now it's 4, now it's 4.25, now it's 4.5. It's a, you know, it's not quite a shocker. Okay. And it may, you know, in a rising rate environment might be, you know, an instigator to get them to make a little bit better offers on these houses so they get one. So yeah, so Monday you could have your prospects. Then Tuesday you call up agents, and if you've got deals working, you can call the agents that are all involved in your deals or your buyers, even if they haven't been under contract, just to give them an update. Hey, listen, I talked to Harry and Martha, and they're still trying to go buy North Fulton. Just between you and me, I think they can go from 450 to 500 without an issue. Does that help? Okay, thanks for the. So you call those in. And then Wednesday, the next group would be like agents that you're not doing business with. Maybe you saw them at a luncheon or they have a new listing or something, and you contact that group. And then the next day, maybe you zero in on past customers if you have them, just to say, hey, boy, are you lucky? You locked in at 3.5. Can you believe rates are 4.5? It's just crazy. The market's crazy. But listen, if you have any friends that haven't bought a house, you know, please give them my name and whatever. So, you know, so you break those up and you're disciplined about it. And it really, really works. It really works, because what a lot of us do is we know we have to make our prospecting calls, but you've got that loan that's on fire and the closing that's happening tomorrow and just stuff that you have to get to. So you do that and it takes longer. And then it's, you know, then you're like, well, I was supposed to make my calls at 10:30, but now it's 12:30 and people are at lunch. I'll wait. And then somebody calls about a new loan and now it's 2 o'clock and you're working on your new loan, and then it's 3 o'clock and then you say, oh, 5 o'clock, people are going to be in traffic driving to and from. Let me wait till then 6:30, it's dinner time. You're like, I don't want to interrupt their dinner time. And then all of a sudden it's 8:30 at night. And you're like, oh God, it's too late now. I'm not going to be bothering people when they're doing their little, you know, family time before bed. So, you know, so that's why you put it on the calendar. That was basically, that was my day in working out, not prospecting, but actually doing my workout, where I just push it along until finally I'm too tired and then I don't have to do it. Right. And that's, you know, and that's why I look the way I look. So, yeah, so you put that in there in your schedule, and that's the idea with the power hour. And if you're just getting started, you don't have many agents, you don't have many past customers, then I have no objection. You know, the first 90 days, go with a power half hour. Okay, it's the discipline part and the regiment part that is the key to the success. Go ahead.
Oh, sorry. I have a question. So as when you first start out, like how many, so you said you only need like half hour to prospecting in a day. Is that what you're saying?
Well,
That's what your suggestion?
Listen, when you first start out and you don't have any loans to work on, then you should be prospecting most of your time. Probably 80% of your time is getting out there and meeting people. But I'm talking about being disciplined as far as that time of the day where you're putting on your headset or your Bluetooth and you're sitting at your office, either at work or at home, and you designate that time and you're religious about it. So no matter what happens between 10 and 10:30 on Wednesday, I'm calling to set agent appointments, you know, and between 10 and whatever, if you're doing the hour between 10 and 11 on Tuesday, I'm calling my existing agents to give them an update on their loans, you know, and you're religious about it, and that agents like that. And I went to I call every Tuesday and give the agents an update that are in the pipeline. And we got to the point where we were a couple weeks from closing, and I called them on Tuesday after it was clear to close. And I'm like, hey, listen, I don't have anything to tell you. The loan's been done, but I made a commitment to you, which I tell new agents. I'm going to call you every Tuesday and give you an update. I made a commitment to you to call you. And so now I'm calling. So, hey, what's up? And they laugh and all. And then, you know, you get to the closing and they make some comment about, yeah, he calls me every Tuesday, even when he doesn't have anything to say, and people laugh, you know. So it really works. And the agents see that and they like it. Okay. So we saw this video from our friend at that has the mastermind, MLO mastermind, Shekhar, and he is a little bit dry. I actually like the videos where he has a guest, but he is super smart and he's built this incredible business. He's like in the top, I don't know, 25 LO. He closed 600 loans last year. So we certainly want to, you know, pay attention to what he has to say. So who we got on? Did anybody listen to that interview? You did, Nitty. So give me a couple. I have a couple points written down. Give me a couple points that you picked up on.
Okay. One thing that I'll do now, once I send them the pre-approval, that I'll send them the inexpensive gift. Just something to tell them that I'm right here. I know this would be a stressful journey. Just take a break, go watch a movie. I like that idea. So I am actually going right now to Costco to get the AMC tickets so that I keep them handy with me.
Nice.
And
Okay.
then I also like the idea of him telling, no one knows what to do once you have locked the rate. Like, don't buy the car, don't close your accounts. No one knows. We have to tell them. And him saying, make a video of it, made sense to me. And then the third thing that he said was, after your loan closed, how can you be in touch with them? And he has a plan of 5 years. I'm starting with 1 year to just give them like, see, so yesterday I talked to my customer that, see, we closed you at 2.875. Now the rate for refinance is 4.25.
Oh.
And he was like, good times. I'm like, yeah. So, and he was like, I'll be in the market maybe this year for looking for a new house, and I'll definitely be in touch with you. So
that's great. Yeah. And you ask for referrals. Maybe they have friends or whatnot. So yeah, so those are all really good points. So the other thing, a few things that I picked up on is, so we always talk about having the latest and greatest technology in the industry, but you know, there's a saying that I really like, and that's that technology can meet expectations, but it's only people that can exceed expectations. So you do have to set aside, even those millennials that want to do the loan app on their phone and take the pictures of their stuff and all that, you know, you'll never get referrals from that person unless you can build some rapport. And so you've got to have a 20 to 30 minute conversation one time with everybody so that you can get to know them and they can, you know, see your personality and so forth. Because that's what's going to stick in their mind. Other than that, you know, it's like a utility of, you know, ordering Uber Eats or something. And we don't want to fall into that category, because if you do, then it's all about price. Okay. You know, credibility through empathy. When you hear, this is something that we talk about in our book club, when you're talking to them, you know, empathize with them. If they tell you, I mean, you're not going to make up a story. If they tell you they're divorced, you're not going to say, oh, I'm divorced too. No, you're not going to say that. You're gonna, but there's something that you can empathize with them. If they've, you know, if they've got kids and you say, oh, you know, I've got a child that's starting middle school or whatever it is. So, you know, the more personal connection you can make to them, the better. And if it's guys, 90% of them are into some sort of sports team. So sports is always a good one. Okay. He uses a phrase, what this means for you. So oftentimes we talk to these borrowers, but they don't know the lingo. And I'm not talking about, you know, the lingo like, you know, basis points and mortgage-backed securities. I'm talking about just like regular lingo. Like, okay, So I pulled your credit and you pulled 722. And the person says, okay, what does that mean? You know, or so he uses the phrase, what this means for you. So you pull their credit and it's a 675. Okay, I don't know, is that good? What does that mean? Okay, well, what that means for you is that an FHA loan is going to be the best fit and give you the best deal, right? So you can use those, say, you know, so they're self-employed. Okay, well, who cares? What difference does it make if I'm self-employed? Okay, but what that means is that I'm going to need your tax returns. So, you know, that I like that expression, what that means for you, after we say any kind of industry talk. You know, how does that actually affect them? The other things he had a suggestion, you know, you call and review the CD with them. And then, of course, he had a suggestion that after closing, you go ahead and send them a first payment coupon. Of course, they get it with their closing package. Most of the time, the loan is set up before they even get their first payments due. But, you know, it is a time where an excuse that you can say, hey, here's a first payment coupon. Your first payment's due next week. And then they'll probably say, oh, I got a letter in the mail and it's already set up. And you'd be, oh, okay, that's great. Oh, we were fast that time. Okay, I just wanted to make sure that your first payment was going to be on time and that you knew where to send it and how much to send. So it's like a caring thing I thought was really good. Anything else? Or did anybody else listen to it? Okay. So,
Can you,
what? Go ahead.
sorry, can you tell me who is that person that we were talking about, the video that Nydia were talking about?
Right. So you're new. So I'll send you the link. So I subscribe to MLO Masterclass, and this guy, is it Shashank or Shekhar?
Shashank.
Shashank. Okay. So he's a terrific loan officer out west, and I admire him. So I subscribe to his service, and he has a lot of really good interviews and so forth. So what we do is we pick one every week and then we talk about it. So I'll send you the link.
Yes, sir, thank you.
You know, going back to what you said about mortgage lingo.
What is your excuse? I'm sorry, excuse me 1 second. So Yanni, what email do you use? You don't use that whole last name, do you?
No, I asked them to use just my first name and then at Van Dyke Mortgage, so that it's easy because it's intimidating.
Okay. Okay, go ahead, person with question.
And that was me. What was my question? Oh, going back to the mortgage lingo. I catch myself a lot of times with clients, once I've already got them under contract, you know, abbreviating things like we do all the time. You know, I'll send them a message, hey, we're CTC, or hey, it's been sent to the UW, or I need an LOX, and they never know what I'm talking about. So
Right.
I actually got with Adam is my marketing person, and Kate and I got with him and sent him a list of common mortgage terms, and he actually put it in a flyer for us. And
Oh.
it is really fantastic. So now
Well, please
yeah, it's great.
send it to
I'll send you a copy, because we're actually going to start sending it to all of our clients once we get under contract, so that they can just see, you know, what is an AUS or what is a GUS, or, you know, all these different things. And I think that will help tremendously for buyers, because it's just habit for us, I think.
Well, I think that it's terrific that you made a little directory, and I'd love to have a copy. But in reality, you just shouldn't use those terms. You should just say it in their language. I need a letter of explanation for this. And you know, and even things like your loan is conditionally approved. Well, we're, you know, relieved when we get conditional approval, but they have no idea what that means. That sounds like they didn't even like it. The underwriter had to step in and make like the conditions and provisions for me because my loan was so bad. They don't know. So you have to say we have conditional approval. And what that means is we are, you know, rounding third base headed for home. So, you know, something like that.
Gotcha.
So, anybody else have any comments about that? Okay, and then the last one we're doing, who's doing BombBomb videos? Okay, besides those prospects that don't respond to anybody about anything, What about the rest of the people you send them to?
I got a good response. Like my realtor was in Costa Rica, and that's when I sent her a video. Yay, we got the appraisal back at 560. She was like, she messaged me, Nidhi, I loved your video, the way you sounded, and thank you so much for taking care of it.
So who else is using BombBomb? Adam, did you sign up?
Yeah, I do. I have a trial that they gave me an extended trial, so I'll just leave it at that. But yeah, so I'm utilizing that. Oh yeah, I've done a bunch. I do. Usually I do a couple every week to realtors, but I do them every weekend after I leave an open house after meeting a new realtor. So I just send them a message in the driveway, and they work out pretty well.
Has anybody said anything? Have you got any responses?
Oh yeah, the one I did 2 weeks ago, they sent me, just because I showed up and I did that, they called me 2 hours later and we locked in a new client, selling their house and doing a jumbo. So yeah, it's great.
Nice. So is anybody else using BombBomb?
I have it, but I have not, other than playing around, made the first video yet.
Stephanie, Yanni? Okay.
I am debating only because I don't know which one to set it up with yet, which price plan, because being brand new, I don't know which.
Okay, so sign up for the free trial, try it a few times, and Yanni, it's called BombBomb. And what they do is they have this technology where they embed a video in an email. And so they have an exclusive on that. So you see like a 2 or 3 seconds of the video. It's very eye-catching, and then when you click on it, it plays the video. So people really like it. So both of you, your assignment is to try out the free trial. And then if you really like it, you know, maybe have a talk with your manager. I don't want to spend anybody else's money, but you may want to talk about it. Okay.
Now, I know one of the cool things that I did last weekend, my granddaughters play soccer. So Lori actually made me a cup. This is Van Dyke Mortgage on it. And I took a picture and posted it on my Facebook and said that I was at the soccer fields. And then last night I was at my granddaughter's practice, and I had 3 realtors walk up to me and say, hey, I saw your cup on your Facebook. Can you tell me more about who you are, who Van Dyke is? One of them was like, we started talking and they never heard about jumbos and different products we offered. And so that was
That's awesome. Cool. So yeah, so this is the theme that we've kind of pounded over and over, and also worth repeating. We use the, what is the name of the strategy that we use, Nidhi?
Jab, jab, hook.
Did you have 3 jabs in there? Anyway, Nidhi's absolutely right. So it's an old boxing term. We use the phrase jab, 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 hook, meaning you give. In that video that you did, or the picture of the cup was actually entertaining. So that's a give. So you give, and then it's okay to ask. You can't ask for business every time. If you put an ad that says that we now offer jumbo rates in-house, okay, that's an ask. You're asking for people to send you, okay, but pictures at the baseball field or wherever you were and all that stuff, you know, that's all giving, and people like that, you know, that show the Kardashians has been on for like 25 years. I mean, people just like looking into people's lives. So, you know, I know that it's very awkward for a lot of people when you're private, you don't really want to share all that, but just those pictures with family and kids and stuff, people eat them up, right? Nidhi did a little video about how she was out in the snow, and it got like a gazillion likes and this and that, you know, and it had nothing to do with business. But then those people know her and like her, and then all of a sudden it embeds in their brain, Nidhi, nice lady, I like her. And then they, you know, a year and a half from now, they're looking for a mortgage and they're still remembering, oh, I remember Nidhi, that was the person that I liked, and let me just give her a call. So, you know, that's kind of how it works. Jab, 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 hook.
Yeah, okay. Like I said, it was just random that
she
came up to me, and her daughter and my granddaughter play on the same team. And she was like, hey, I've got a couple questions for you. And, you know, and we just started chit chatting, and So,
One piece of advice, more.
yeah.
Okay, so, so we saw these, BombBomb had these 15 different, things, and I thought they were very, very simplistic. 15 ways to help you get more business. And of course, the answer to all 15 was to use their video service, which is fine. That's what they do. But any of those catch your eye, Nitty?
One was the mortgage inquiry, of course. The second one, which I really liked and I want to do it, is client schedule. Like this is, so you got the pre-approval, now you are in binding. After binding, what happens? Wait lock. Then we order the appraisal. How much time does the appraisal takes? On a board that these are the steps. This is the schedule that will follow.
You talking about the lady in front of the calendar?
Yes.
Mhm.
Yes.
That was by far my favorite video. So there's this video, one of the ones, you use these little short videos to give updates and explanation, and it's more of a personal touch. And they give you some examples. And what's funny is how the examples are like completely raw. I mean, they don't polish them up at all. But I mean, that's the way people are, and that's the way people like it. But there was one that I thought was really super. Was this loan officer was in front of a calendar, and it was a big calendar, and she was like, okay, just pretend like this is, squares of a calendar. And she was like, okay, so we did our loan application on this day. So we need to order the appraisal on this day, which means I've got to get your stuff. And it said something like deadline for borrower stuff on this day right here, so that we can do this in time. And then we can close on this day right here. And it really, I mean, it just slapped you in the face as to, oh, I need to follow exactly what she's saying, so that I can close on time.
Video, I ordered the calendar too.
Oh
I'll
God,
show you.
Betty's one step ahead of me. No, that's terrific. What, did you get that from Office Depot?
Yeah, Office Depot, yes.
Okay, yeah, so that's really terrific. So that was my favorite video. She actually, the woman used a chalkboard, but it's exactly the same premise. So anyway, but there's a million ways to use these videos. And let me see. Yeah, I mean, most of them were just general sales, keep in touch, have more touch points. And also, don't be afraid to ask. I feel like whenever you have good news, the appraisal came back, if it wasn't short, appraisal came back, conditional loan approval, those are the times that you say, hey, do you know of anybody thinking about buying or selling a home? Because they're still, your relationship is, it's symbiotic at that point, right? You need them for the business. They need you to finish their loan. So then they're more in a mood to kind of go the extra mile to help you out, where after you close, they don't need you anymore. I mean, not saying that people wouldn't be, pleasant and considerate, but I'm just saying that from a practicality point, they don't really need to have any more conversations with you after they close on their house. So they're not as likely to go the extra mile to refer you their friends and family. Maybe in the back of their mind, they're thinking, gosh, if I could refer Nitty a couple of people, maybe she'll make sure my package is there early or something like that. I don't know what goes on in people's minds, but that's the time. Whenever you have positive news, you should ask them for a referral. And the same with the realtors. When you call the realtors and you tell them, hey, we just got the appraisal done, or your loan just got approved, 10 days before closing, is there anybody else that you're working with? So that's really a good time. I'll tell you a quick story. Is I had an agent who sends me business this has just happened yesterday. Her name's Tracy, and she sends me a customer every couple of months, which is terrific. She's not a big producer. And then I got this loan app, and the person on the voicemail said, Tracy gave me your name. So I called her and I said, the Andersons called, and she's like, who are they? Who are they? And I said, they're moving from Colorado. That's not my customer. And I went back and I asked him, and it was a different Tracy. Okay. But the Tracy that I called mistakenly, while I was on the phone, she says, well, check that out. But in the meantime, I've got this other couple that I want you to talk to. Okay. So, yeah, as I'm apologizing, oh my God, I guess I couldn't hear her clearly on the voicemail, whatever. She's like, oh, that's all right. So let me ask you about this other thing. Do you do VA loans? Yeah, of course. And then she's got another. Now she may have called me later to give me that prospect. I don't know, but I sure liked getting it right then and there. So, so that's the scoop. So we have gone way long, so I'm not going to do 10 questions until next week. Is there anything that anybody else wants to say? Thank you so much. I hope you learned something. I'll send you those Excel spreadsheets. Call or email me if you have any questions about that. And
I actually have a question.
sure, go right ahead.
So I know that the Fed, we're talking about hike rate for the next eight meetings, something like that. What does that mean to us? I know they're talking about 25 basis points. But what does that mean for interest rate?
Okay.
In coming up meetings and stuff like that.
Okay, so you're stuck about it with me for another 90 seconds to answer this question. Okay, so this is a strange concept, but we move ahead of the Fed. You're like, how's that possible? How do you react to something before it happens? Okay, this is what happened. So the Fed moved for the first time, was it last week or the week before? But
last
anyway,
week,
what?
Oh, I was gonna say like the 15 or the 16.
Yeah, so just about a week ago, the Fed raised rates for the first time, right? We have already priced in, I believe, 6 rate changes, right? Because we've already gone up a whole 1.5%, basically, from the low of the rates, right? So we've moved ahead. We already raised the rates. So now, so we move on the rumor. I mean, you're just talking about raising rates. We're raising rates, okay? So now the Fed has to simply go through with what we think they're going to do. And nothing negative will happen until the Fed surprises us. So we're expecting 6 quarter-point raises, 4 this year, 2 more next year. So if the Fed were to say that, well, we're only going to go 5, then we'll see a little improvement. What they did this last time, which was really nasty, is they went the quarter like we suggested, or I'm sorry, we went the quarter like we forecasted, and then they added some language that says, you know what, we're buying a lot of these mortgage bonds. We're going to start slacking off, changing our balance sheet so we don't buy as many mortgage bonds. And that's what hit us in the face. That was surprised us. So actually, if the Fed raises methodically like we think they're going to do, we may actually find comfort and see a little bit of improvement, which is a real paradox, but it happens almost every time the Fed raises, we see mortgage rates improve because we've already forecasted, and chances are we overreacted like we always do. And then when the Fed does, like we're like, yeah, this is going exactly like planned. We're comfortable with all this. We're going to improve, we're going to buy into the bonds and improve the rates a little bit. So I know it sounds counterintuitive, but we've already made 6 adjustments to I mean, you see it in the rate sheet, right?
Oh, yeah.
Yeah. So that's the scoop.
I think we should be getting CE credit for this.
Yeah. So unless the Fed surprises us, they'll have no effect on the rates, maybe even slightly positive. Okay. Any other questions? All right, you guys, you're getting college credit down at Georgia Tech for this. All right.
We should.
Have a great day. Talk to you later.
Thanks.
Thank
Susan.
you.
Thank you.
Bye.
How do I do this? Leave.